So let's look at inventory. Now, an important note at the top of this video is that we'll be looking at what is commonly referred to as a top-down build of inventory. That is, your inventory analysis is driven by your cost of goods sold forecasts, which are commonly related to your revenue forecasts. That is, as you move your revenue forecasts, your cost of goods sold, and therefore inventory analysis, adjust in line with this. Now, often inventory-heavy businesses will do what's referred to as a bottom-up build of inventory. That is, forecasting your inputs and inventory purchases, and then relating this to your cost of goods sold forecast. This is often very complex and can mean that you need to backsolve your inventory purchases when adjusting your revenue forecasts. So for simplicity, this is why we use a top-down approach. If you're looking for more advanced inventory analysis or a bottom-up build, then please reach out to our support team, as we have a lot of experience modeling this and we'd be more than happy to help you. When we first bring your historical inventory balances into your financial model from your accounting package, they're brought into your historical balance sheet. As you can see, our inventory is located below our debtors within our current assets, and in this example, we have three categories of inventory, those being Cocoa Bix, Just Wrong, and NutriBubbles balances. We have our historical closing balances on the right-hand side of the sheet, and if I scroll across our time series until our closing historical period of June 22, we can then see that we have our closing balances. Looking at Cocoa Bix sales, for example, we have a closing balance of 787.7 in June 22. Now, when we forecast your inventory balances, this is handled on our working capital sheet below our debtors analysis. Now, as we said at the top of this video, our inventory analysis here is using a top-down approach. That is, our inventory analysis is being driven by our cost of goods sold forecasts, which you can see are being brought in at the top of the analysis here. And looking at our Cocoa Bix inventory as an example, we can see that our 787.7 opening balance is being brought through from our historical balance sheet. Now, we can see that this analysis is using an inventory receipt period days assumption. The way that this analysis works is that we look ahead to your forecast cost of goods sold, or the forecast value of inventory required to meet our forecast sales, and based on our assumption of the number of days it will take for us on average to receive that inventory, and solving to calculate what our inventory purchases need to be in this current month to meet our forecast sales requirements. Let's look at September 22 as an example. Looking at our T account structure, we can see that we have an opening balance of 904.6. We calculate inventory purchases of 588.1, less our cost of goods sold of 644.7, or the value of the Cocoa Bix inventory going out the door related to our Cocoa Bix sales, gives us our closing balance for the period. Now we can see this 644.7 is coming from our cost of goods sold forecasts, which are being brought in at the top of the analysis. The opening balance is also being brought forward from the previous month's closing balance. So the two items that we focus on are our inventory purchases and our closing balance. So looking ahead from the end of September, we know that we must have enough stock to meet the next 45 days requirements. Now we assume that COGS is expensed evenly throughout a period. So based on a 45 days assumption, we must have the entire month of October's cost of goods sold, as well as 14 days out of the 30 days in November's balance as well. That proportion of November's COGS, being just under half, plus the entire month of October's COGS, then gives us our closing balance of 848.1. As we know the value of stock that we must have on hand to meet the requirements over the next 45 days, we then solve for our inventory purchases based on this. In the month of September, we have an opening balance of 904.6. As our cost of goods sold forecasts have 644.7 of inventory going out the door, we then must purchase 588.1 so that we have our closing balance of 848.1, reflecting the requirements for the next 45 days. Now, when we look at the financial statement impacts, inventory is included within our current assets on the balance sheet and is also accounted for within the cash payments on our operating section of the cash flow statement. The cash payment for inventory decreases our change in cash held, therefore decreasing cash at bank, which is matched by the increase in inventory value on the balance sheet. Now, it's important to note that inventory is comprised of two components. The value of inventory purchased in a period, which remains on the balance sheet, reflected in the balances on screen, as well as the inventory that was purchased and consequently sold within the same period too, which would be reflected in our cost of goods sold balance. In this example on screen, we had purchased $110 worth of stock, which we had managed to sell $10 of, and a remaining $100 of inventory remained on our balance sheet. Now, hopping back into our example, in the month of September 22, we can see that we had an opening balance of 904.6 and a closing balance of 848.1, with the difference between these being a downwards movement of 56.5. If we want to see the adjustment on the cash flow statement for the movement in our inventory balance of 56.5, as well as our closing balance on the balance sheet of 848.1, we can head back to our table of contents and then activate our financial statements. Firstly, looking at our balance sheet, if we expand our inventory collapse rows within our current assets, with the first category being Cocoa Bix sales, if we then scroll across our time series until we get to our forecast month of September 22, we can then see we have our closing balance of 848.1 for Cocoa Bix inventory. Then, if we want to see the cash flow adjustment for our inventory balance change, we can scroll down to our cash flow statement and expand our cash payment section. Again, with our top category being Cocoa Bix sales, we can then see we have our adjustment for 56.5 in the movement of our inventory balances. Now, within a full through our financial model, inventory also affects our inventory payables and our GST considerations. Following on with our example of $110 of stock being purchased within a period, if we are yet to pay our supplier for this, we would then need to adjust for this within our inventory payables balance. And if we had GST within our model, we would then need to adjust for the GST. Now, as always, these considerations will be handled within their own videos. However, for the purposes of this video, when we're looking at the financial statement impacts of inventory within a three-way financial model, inventory is included within the current assets on our balance sheet and is also accounted for within the cash payments in the operating section of the cash flows. The movement in our inventory balance is matched by an adjustment to cash, therefore balancing our total assets and balancing the balance sheet.